So, all right then, team. Very good afternoon to you all. Charles here, of course. It's Sunday, the 15th of February. Just chart preparation, really, for Monday. And as I always say, fail to prepare, prepare to fail, pretty much. It's good to go into a Monday with a nice idea of where price action is, right? Let's just admit NMC, good to see him on board as well. And as we know, price can, of course, move come Monday morning. All of our higher time frame. Good afternoon, NMC. I hope you're doing well. Price can move, of course, come Monday morning. But in the event that it doesn't, who doesn't want to have a very easy head start into the charts come Monday morning? So that's what I do, to be honest. It doesn't take too long, and I'm sure Boris does this. I'm pretty sure Victor does it. He was in Frgnt Mastery, so if he's looking to execute trade, or if anyone is really looking to execute trades first thing on Monday morning, you don't want to be marking up your charts while you're looking to execute the trade, right? That's sort of it's not where you really want to be. So nevertheless, let's take a look into it. Of course, as I said, things can obviously change, but in the event that it doesn't, we do hope at least the higher time frames, they will certainly, hopefully, unless there's no dramatic news that will start looking to breach those higher time frame points of interest, more often than not, you're going to be on the correct side of the market when price opens on Monday. So let's take a look. Where are we first and foremost? As I said, it's not going to be a lengthy call, but certainly to get us all in the mood for Monday. So the DXY is always a grand place to start, to be honest. But as we've seen over the couple of weeks, I mean, last week I'd say the DXY is pretty predictable. Nothing crazy happened on the DXY, but nevertheless, it's good, as I said, to have a little foundation on where price is looking to be. Key points of areas, key points of interest. So the DXY, if I zoom out completely, you can see why we were held within this weekly order block. Price hadn't gone below that area, let's call it since February 2022. So if you just use the facts on board, would the DXY, does the dollar index really want to be going any lower than that? Evidently, no. As prices come into that area once, it's had a move off. It's come into the area twice. Look at the tremendous wick rejection to the downside, suggesting that the DXY or whoever is holding up that dollar index does not want it to go below these areas. And again, we wicked into that area, I think 2 weeks ago, when we were having, me personally, having a bit of a crappy week. What was it? I think it could have been around week 3 or 4 of Q1. As a result of that move on the DXY that actually went below that area, those key points of interest on GU, EU, and AU, for good example, where the DXY is pretty much the king, played a little bit of havoc. So as you can see, if you can't predict where price is looking to go, even on those higher time frames on the DXY, it does make your life tremendously harder. Then, of course, once you're aligned across all of those, across the indexes and then the pair that you're trading, then it makes things a lot easier, right? So where do I foresee the DXY to go at the moment? Well, I certainly don't expect it to come down towards these lows. If it does, I do foresee that in that case, we're going to be using that wick imbalance because it's quite clear to me. And as I always say, we use the facts, and with the facts, we then build the story. But we don't make a story up. We just use what's on in front of us, right? On the charts. Keep it as simple as that. So we've got that wick imbalance to the low, of which that tremendous weekly candle that printed bearish and then closed bullish above the area. As I said, if price is looking to come down to those lows, I am then going to expect a bullish reaction from that DXY to push price higher. With that said, once the DXY strengthens, we'll then be looking for points of interest, for example, up at the highs on GU, EU, and AU, for them to take advantage of the strength coming in from the dollar, which will then look as if pound is getting weak against it, euro is getting weak against it, and Aussie dollar is also becoming weak against it. So it's tying everything into the correct story and then just using those facts, right? So where's price again now? So we close bearish, we close rejecting a daily order block down at the lows here. Once I go down through the time frames, you'll see that daily order block and how we got that rejection to close just above it. And then we've got the daily 50 MA right up at the highs again. So if I'm looking for a nice trading range on the DXY, I can see it between that daily 50 MA and then between those wick imbalances, previous weekly lows, that is the trading range, in my opinion, of the DXY. I'm not really concerned, as I always say, on price action looking to the left. Of course, we can take it into consideration. Price is bearish below the weekly 50 MA. So if price does come up to that weekly 50 MA, again, what would you be expecting based on price coming into the weekly 50 MA there? Based on if I clone this very simply and bring it down, price coming into the weekly 50 MA there. And again, if price is going to come into the weekly 50 MA, my arrow is illustrating exactly where I foresee price to go. Nevertheless, as I don't use fundamentals as part of my analysis, I am simply basing my forecast based on smart money concepts, higher time frame order blocks, points of interest. But the fundamental side of my trading is on the side of believing, well, at some point, I do believe price is going to push up above that weekly 50 MA and then would be more inclined to look for clear dollar strength. Not so much the fact that we're anticipating dollar strength in relation to overall dollar weakness, because as we can see, once we're down here, price is most certainly weak on that US dollar, and we'd be trading the pullback of the dollar index to look for those points of interest before looking for a potential lower low. Now, with that said, once we zoom out on that weekly time frame, it's unlikely that price is going to go down there, but that is me coming up with an assumption based upon facts. If price is going to dip below this weekly order block, then I foresee it's going to then come into the daily order block underneath, again, where price hasn't been down into those areas before Monday, the 10th of January, 2022. Again, so we're just using all those facts. So for me personally, if I am the DXY or if I am an investor in the dollar index, there is no way that I want that index to go below this area, meaning that if price comes down to those lows, we are expecting then bullish intent coming in from the DXY. So that's just a general overview of the DXY, how I use that to tie into my analysis. And then of course, if I would trade the DXY, I'd use it using the exact same methods that I'm doing across all the other pairs. As you can see, refined order blocks, refined down to the daily, through daily into the 4 hour, etc., and so on and so forth. So again, using the daily time frame, I'm not concerned about the structure or not so much even the overall direction of the DXY as an intraday trader. Of course, it's nice to trade in the direction of your overall bias on the higher time frame. Of course, it is. That is the what's the better way to describe it? That's the preferred method of trading, in fact, trading alongside a higher time frame and directional bias. However, using the DXY, not really concerned, are we? If the DXY is looking bearish or bullish overall, we're more concerned about where is it going to look to go in the immediacy. So, of course, on the daily time frame, it's matching the weekly where we can see a clear lower low in the market, albeit we have broken, or albeit rather before I get into that, we have still rejected that weekly order block. But what's important to notice is that we have created a lower low on that DXY. So any trade that we are going to take in terms of a pushing price up, we need to understand that we are trading a potential lower high before the DXY could potentially, based on facts, look to make a lower low. That's the fact. Whether or not we believe the DXY is going to do that is another story. However, once price does come down here into that wick imbalance, then that will be the decision-making point. Are we going to break that area and make a new low, coming back up for a lower high, lower low continuation? Or are we going to come down into that wick imbalance, fail to make a lower low, and then anything past failing to make a lower low will then be the first high in the market before a potential turnaround? So that's how I'm using the DXY. That's how I analyze across all time frames. And again, I'm not really concerned about anything to the left. If I give you a good scenario, all of this information to me personally is dead information. Now I'm more concerned about how we acting, those points of interest, the EMAs, our previous wick lows and wick imbalances from, let's say, the last couple of weeks, right? So that wick imbalance, we've superimposed that from the weekly time frame. That's showing nice and clear on the daily. Previous weekly low. Again, why do I highlight that? Usually, and more often than not, once your wick imbalances are identified on those higher time frames, i.e. weekly and daily, always more than likely for price to want to retrace into those wick imbalances. And then ordinarily I'll be looking for a reaction from those wick imbalances. If I head back to the weekly time frame, the question that you're asking is why? Well, a wick imbalance or a wick imbalance is suggesting that there is liquidity sat there. The fact that price was pushed up from this wick suggests that there is liquidity sat there. Where is that liquidity sat? It's for us to await those lower time frame breaks of structure, potentially even onto a 4 hour time frame, bullish engulfing candle or a bearish engulfing candle if you're looking for shorts, and then you'll be looking to capture from that wick imbalance. For example, this wick here, if you look to the right, if we came into the charts here, understanding that at some point in the future, this wick will be filled. Once that wick is filled, we'll be looking for a potential position to the upside. If you look to the right now, this wick was filled. As a result of this wick being filled, it then pushed up. And if you were simply to take a longer term position from the same place of that wick, place your stop loss underneath the order block that you're looking to manipulate, then of course that would be a longer term trade on the DXY. However, we don't trade like that. We refine the areas down. As I said, we look for lower time frame breaks of structures, bearish or bullish engulfing candles from the area before then looking to take a position from a wick imbalance. But here is, I hope you can see a good explanation in terms of why we like to trade from wick imbalances. Again, another fine example, a wick to the low, price came in and price took off using that wick to the left just here. If I highlight that so you know what I'm talking about. Looking to the right now, a wick was then, or this wick was filled and price took off in the direction. Again, a wick, price then filled it, took off in the direction. So using the facts, again, rinse and repeat, continue with the same ethos across. This wick was created. Once price comes down to those areas, I'm expecting that wick to be filled, potentially then even create another wick. That would be price making a lower low. And then obviously, if we're looking to take a long position from that area, post getting the confirmation, it should be a good looking trade. So back to the daily time frame, you can now see why these wicks are of nice importance. So previous weekly lows, just here, wick imbalance from that weekly time frame. And then how is price reacting to those EMAs? So the daily 50 EMA, of course, looking on that DXY now, price is respecting it. As a result of that break below, making that lower low, lower high, up into that daily 50 EMA before the turnaround. So in an ideal scenario, just thinking about price action and structure, lower low, lower high, potential lower low continuation. So anything in this area could still well be a lower low continuation. Aside from if price breaks this area, then as we said, even looking at the DXY, once it starts to push up at some point, we must we must start identifying that the DXY now is potentially in an opposite directional turn and then looking for bullish intent as the principal move, not so much just us trading the pullbacks of that DXY looking to go long. So that's where we are at the moment. If we then start to go down through the time frame, superimpose all of those areas, now is where I start to really pay close attention to structure, time frames, how price is printing, just based, as I say, on that basic looking structure. We all know price in a bearish market, lower lows and lower highs. So now it's key for me to try and identify, can I find that? Sorry, guys, I've just got a message here. Okay, cool. NMC had to drop out. So nevertheless, structure. Is it clear for me to identify structure, just basic structure, just staring at that chart? Good afternoon, Ian. Just staring at that chart, can I work out basic structure? Being honest, I can't. But what I always would look to do is just start by saying, right, if a low in the market has been created, looking to the left, clear lower low. So after a lower low, I am always expecting a lower high followed by a continuation lower low. The moment I don't get that lower low, my mindset then starts to shift. Am I now in a different phase of price action? Am I now looking to make a high in the market after that high, higher low for that higher high continuation? So at the time, I draw it on always lower low, potential lower high, but we do not have that confirmed as a result of price actually not breaking that most recent low for now. So at the moment, personally for me on the DXY, in the middle of a bit of no man's land, but again, that's when we start to look at the 4 hour 50 EMA. How is price acting in that 4 hour 50 EMA? It's respecting it. So from that 4 hour 50 EMA, I am expecting potentially now could be the time to start making that lower low. If it doesn't, as I've then said, we could start bouncing off of that area. And for me, this would then be the first potential sign of a high in the market, followed by a higher low, higher high, and then at some point the trend must change. So for now, again, it's a DXY, it's very broadly speaking, and there's enough range between the daily 50 EMA and these wick imbalances for us to look for good trades on GU, EU, and AU for good example. And then to take the DXY out of the equation completely, then we'll be looking at pairs such as EG, for example. So that's just a general overview of the DXY, how I mark the charts up, general speaking, over the weekend. Don't necessarily have to go down through all of the time frames because the 15 minute and the 4 hour, more often than not, by the time I look at the price action come Monday morning, the 15 minute most certainly would have changed more often than not quite dramatically. The 4 hour, we can hope those key areas, those order blocks are holding, and then we can look for breaks of structures from those areas come London open. So with that said, we'll just jump straight into EU onto the higher time frames first of all, and we'll go from there with another breakdown. Cool. So weekly time frame. Again, am I concerned about general directional bias? Not particularly. I'm not paying attention to all of this information to the left. I'm more concerned, as I always say, the most recent candle closures. How have they closed? Are they respecting EMAs? Are they by any EMAs? And higher time frame order blocks, wick imbalances, etc. However, with that said, if it's clear and obvious, great, I'll take it into consideration when I'm looking to take a trade. I can journal that, right, I am trading in the direction of the overall direction on the weekly time frame. For example, if I was going to take a long position now, then I would most certainly look at journaling that and putting it as a confluence for the trade. But as I said, it's not the be all and end all of intraday trading, whether you're trading in the direction of the weekly or the daily time frame. So weekly 50 EMA down at the lows, not really a consideration for me at this time. However, I do know if price was to come down to these lows, test this wick imbalance, as we've had the good example on the DXY to begin with, how wick imbalances work. Then, of course, we can expect a long from that wick imbalance. What we then have as a confluence from that is, of course, well, price is trending above the weekly 50 MA. So if price was to then dip below this weekly 50 MA within the week, we would have then, of course, have, let's say, 4 days for price to want to reject that weekly 50 MA, find a valid point of interest underneath it, which we most certainly have by way of wick imbalance. Refined daily order block is in this area as well that has not been tapped based upon these candles that are above. And then we also have the 4 hour order block below that area. So we definitely have a valid point of interest based on that wick imbalance where we will look to foresee price to bounce away from on this pair. So and again, just to finish off the illustration, what we then expect to see on that weekly time frame, come that weekly candle close of business on Friday, is going to be another candle like that. Would it make sense? Well, of course, if you look up to the tops here, you do see those wick imbalance candles print. You've got one here, here. Many of these weekly candles will have wicks, and as you start to manipulate those wicks, as I said, more often than not, you can indeed find a decent position at least to push yourself towards break even, which, as we always say, is pretty much job done. If you're able to execute a great setup in line with a great entry criteria and you're able to move that position to break even, an investor is going to be very happy that you've managed to risk money, take the risk off, and still have the opportunity to make money. That's every investor's dream, right? So wick imbalance to the high, previous weekly highs. Again, a nice example that not every wick needs to be highlighted. It's more so the bigger wicks that you can say, well, there's clear liquidity sat here in the market, and for some reason, whatever reason it is, I personally do not get involved in fundamentals because technical analysis is more than enough to take into consideration when trading the pairs, but it's very clear that a wick imbalance shows that there is liquidity there. So for whatever reason, based on technicals or fundamentals, if I look to the left, perhaps there is an area of interest to the left. That would be filling imbalance almost. So again, the technicals aren't clear, so perhaps the fundamentals are showing that for whatever reason, price should not go above this area. So we'll take it into consideration. We've marked that wick imbalance off, and then of course, once price comes up to those areas, once we've found a good enough setup to take that we can journal, followed by a standard entry technique, or I personally would be looking from a short from that wick imbalance based upon history. Simple as that. Previous weekly high. So this wick isn't tremendously large, so I'm not expecting a huge reaction from there. So perhaps from this area, which you would say is in the middle of nowhere, and looking at that weekly time frame that is clearly bullish, and recognizing that in this area here, that we are expecting this wick to be filled, this could indeed be one of those positions where you'd have to be in sharp and manage your risk even sharp and moving to break even. So already just judging by the weekly time frame, you're able to come up with a conclusion where, right, I know my best position if I'm going to short is at the moment going to come from this wick imbalance. Of course, above those areas, we've got order blocks, and I would much prefer to trade from an order block more so than a wick imbalance. However, judging on the scale of this wick, here does suggest that we do have valid liquidity, as I said. So I'll be looking for a position from there. This area, previous weekly high, it doesn't for me, just judging on the side of the wicks. If someone is to tell you you've got one trade, risk 50,000 on that trade, you've got one wick imbalance here, or you've got a previous weekly high that is also giving you a wick imbalance, it's very clear for me personally to say, well, I'd much rather wait for this area based upon the size of the wick. That is telling me that there's more liquidity sat here than there is sat there. And that's just the facts. We use those facts, we build the story, and we trade, right? So, with that said, previous weekly high, there is a 4 hour order block in and around that area. But again, judging by just that weekly time frame, you need to be in the mindset of understanding without looking what's happening on the lower time frames. Quite clearly, we are making higher highs and higher lows on that weekly time frame, evidently bullish. So any short position from that area, I can already see and say would be a reversal type of looking trade, right? And then it's down to you as an individual, as a trader. Would you prefer to take a reversal, or would you prefer to trade alongside intraday structure and intraday timeframes, right? Of what price is actually doing. Again, it's a personal decision. I would always be looking to trade in both directions. But that's just my trading style, right? It's down to the individual to come up with how they are comfortable about trading. Again, wick imbalance here on the weekly time frame. And again, it's the same sort of quotation. Is this going to provide me with the same amount of liquidity that I have from this area? More than likely not. But what I've got on side as a confluence to help me take this trade is I already can see, judging by this white gam box, is that I've got a daily order block sat there. That daily order block is also supported by the daily 50 MA. And judging by the fact the weekly candle closed up here, I already know on intraday perspective that the daily time frame is above that daily 50 MA. So again, using the facts, once price comes down into that daily 50 MA, what am I expecting? A rejection at some stage within the daily candle. I am expecting a rejection from that daily 50 MA. As we go down to the daily 50 MA, we'll come to that understanding, and we'll see how price is respecting those daily 50 MAs. So as we go down through the time frame now to the daily, and let's see what we have. So we'll start with the 50 EMA analogy. So price wasn't doing a lot here. So more often than not, once price, or rather, if I word it, when you see the EMA trading between or trading in the middle of price action, it just suggests to me that price is ranging. And if you look at the highs and lows of that, you can then come to the conclusion that the EMA is not telling any lies. We were ranging and price wasn't doing anything at all. Then you had the explosion upwards, and price broke above that EMA. And straight away, as price broke above, came back to retest that EMA, we continued to respect it. So I have the same analysis using the facts. Once price comes back down to that daily 50 EMA, I just have to ask myself, based upon history, based upon what price is showing me and telling me, what's going to happen? I ask myself, Charles, what's going to happen? What can you forecast when price comes back down to that daily 50 MA? Well, I use the facts. I'm going to say when price comes into these areas, I'm going to forecast that price is going to reject it at some stage and push up to the most other or the most restricted EMA, which in this case, price closed just above it. So it would not be the EMA. It will be the previous weekly high, but we'll go down to the 4 hour time frame shortly. So with that said, where's a point of interest that we can look for? Of course, the daily 50, excuse me, the daily order block down at these lows. If price comes down to here, then I already know. Probably if this happens within the same day, let's say Monday morning opens and price is all the way down here. Here is the low of that candle. I will then say to myself, right, although it's quite unrealistic, again, it's not for me to detract from the facts. I'm expecting, even if the candle, the daily candle, is down here come Monday morning, I will have to expect, based upon the previous daily candles, that there will be some form of rejection. Understood that the candle is below the 50 EMA, and the question that you're going to be asking yourself is, but how is it rejecting it? The analogy is that price would want to look to reject, regardless of where this candle is. It will want to reject that daily 50 MA at some time. Even if it closes there, it will still be rejecting the daily 50 MA. And then the confluence that you have is that any entry below the 50 MA, in this case, if you're looking for long positions, you have that as a confluence that I know price wants. If you take that as a magnet, wherever the EMA is a magnet, wherever price is, I know it is attracted to its EMA. Therefore, I have every confluence and the confidence to take a position down it. It doesn't necessarily mean in my heart of hearts that I'm going to believe that candle is going to absolutely flip bullish and give me a tremendous wick to the low. That's quite wishful thinking. But the thought process must be that price is going to be magnetized towards that EMA. Therefore, if price comes down here, I know that that is my best long position, right? Regardless of the weekly 50 MA being a hell of a lot lower, I'm not concerned about the weekly 50 MA at that point. I'm more concerned about how many hours left of that daily candle do I have for that daily candle to close potentially bullish above that daily 50 MA. Regardless, is it going to be drawn towards that daily 50 EMA? That's what I'm looking to do. However, in the immediacy, when I look at what's more realistic, hence why I'm using this order block here, not so much, well, I've highlighted this order block, or the reason why I haven't then said, okay, well, let's use this order block, which is slightly larger, is because it must mean something. This order block is the lowest order block, and as I always say, your best positions for a long position is going to come from longing from as low as possible. It doesn't mean I wait for price to go all the way down to the absolute lows in the market before I look for a long position. It means in the area that I'm looking at, I need to understand that if I am longing from as low as possible, and in contrast, am I shorting from as high as possible? So for example, I know I've got that wick imbalance here from the previous weekly high. So the best chance I can give myself to take a short isn't taking a position in the middle of nowhere here. Because as soon as I look up, the question I then ask myself is, am I shorting from as high as I possibly can from the area that I've already identified? Am I doing myself any favors whatsoever to short here, regardless of how it may look? And what I mean by that is if we say that price has made a break from that area, and then I'm looking to highlight, if you just play the game with me, a point of interest like this, and then look for a short position from that area, I know in myself that although price has made this low, that could also just mean price has made a high. The higher low is what I'm looking to then trade, and then it's actually price wants to go up to the better place to take the short from. So that is a good example also of when to be patient, when to be fixed on the type of strategy that you're going to be using, and anything else that shows itself in between is just a mere distraction to take you away from your higher probable setups. Of course, we have different ways to take intraday trades if those trades aren't aligning, for such as an Asia range trade. An Asia range does not take into consideration any of the higher time frame confluence. So that's a great example of, right, I want to trade, I'm a trader, can I find any Asia range trades? And even in the expression, can I find a trade? I don't need to find a trade based on my higher time frame analysis. It's already there. That's the better way of trading, in my opinion, always. You mark your positions up, you wait for trades to come to your areas, you don't find trades. However, an Asia range setup is more so for an aggressive trader that doesn't necessarily want to wait for those higher time frame trades to start coming in, and then you're actively looking for Asia range trades, right? You're planning pretty much on the spot. You found a break of structure come London. Does it have a 15-minute valid order block? Is there a 1 minute break of structure post London or after tapping the order block? That's a very active way of trading, if you'd agree. Nevertheless, if you look towards this and your higher time frame directional trades, they're already planned. Unless price comes and breaks these areas, then I'm going to have to rethink, right? But unless price doesn't, or if price does not do that, I'm pretty fixed for the rest of the week, providing that price respects those areas. It's just down to me then to make sure I can find, again, using the word find, or once you can see the trade, then you'll be looking to find your particular setup. But even so, finding a setup is completely different to finding an active trade such as an Asia range position. And I hope that makes sense for those listening actively and those on the recording. Trading with your directional bias, you're not necessarily looking for trades. You've already identified them. An Asia range position is a very aggressive type of trade whereby you are actively searching for those trades. They don't necessarily come to you. You're looking for them, right? So I've made enough emphasis on that. So nevertheless, the daily time frame, where are we? Again, I'm not concerned about structure. And what I mean by that is all of this to the left. In fact, even more of that. I don't really care. Understood there is a daily order block down here that would be used once price gets there, but I'm more inclined about how is price respecting that daily 50 MA, particularly on the daily time frame. So price has most recently closed above, and as I've said previously, once price comes down to this area, then I'll be looking for a long rejecting that daily 50 MA. My preferred method of taking this, for example, I mean, at this stage, it looks all right. But what I would more often than not prefer to see is a point of let's say I'm looking for a long position. My point of interest, I believe, is always better when it is below the EMA, because then you have one confirmation that price, okay, we've got the price has now, it's dipped below the EMA. Now we're searching for price to now give us the confirmation that the order block we've selected, we can validate it. So we validated it previously based upon a move that has come from that area. Now, when price gets back into that area, that's when we want to be looking for our shift in structure drawn to exaggeration, but you see what I say. You hear what I'm saying. The fact that we have the order block above the EMA, at this stage, it doesn't make too much of a difference because what we can understand is as the days start to print, I'll ask a rhetorical question. Where do you think the EMAs are going to go? The EMA will start rising up towards price action. So by the time we'll be looking to take that trade, my preferred method would be the EMA would be there, right? So we breach the EMA, job done, number one. Now come into the order block, job two, give me the turnaround in price, and I'll take my trade from there, right? So that's what we have at the moment. We'll work with it. Again, it's the facts on board. We take them on board, we paint the picture, and we trade what we have. So daily if EMA expecting a rejection from that area. Daily order block, why does that come into consideration? Well, because I've got the wick imbalance there. I've started the story on the weekly time frame. Then, by coincidence, the daily 50 MA is right by that area. Great. So now it's telling me, hey, Charles, look in this area, look to see what's going on. As we then come down the area or come down refining those order blocks and wick imbalances from that higher time frame, there we have it, a daily order block. Now, once we refine that daily order block down as well, I can already see that there is a 4 hour order block underneath that area. So more often than not, I'm going to start looking at structure now on the 4 hour, and hopefully that 4 hour order block is actually in a decent position of structure. That's what I would like to see as I start coming through the time frames. If I can't see that, then it wouldn't invalidate the order block, but it's going to suggest to me that, okay, perhaps this order block is slightly in the middle of nowhere. And we can already understand, judging by that daily order block, that not a lot has really happened from this area. It's just the fact we're using the higher time frames in the EMA to understand that there is potential liquidity in this area. When we say liquidity, it doesn't mean it's going to be enough to take us up to here. What we always forecast is that there's enough liquidity to push our trade to break even. And that's the goal. Of course, the overall goal is to make money, but capital preservation for me has always been the first point of call. And once you learn how to preserve capital, making it is so much more easier, in my opinion, again. But to manage your losses and manage your risk, for me, and being in touch with many investors, that's more what they're concerned about. If someone is to hand you $3 million and say, well, don't lose it, where do you stand if you don't know how to manage your risk when it comes to taking a position, right? You don't know how not to lose the money. Nevertheless, if you know how to make money, you need to learn how not to lose it, right? So here is a nice point of interest, and I understand from that area, perhaps I may not be able to make as much money as I would want to, but I should know from that area I'm able to manage the money enough to get to break even, right? And that is no hint for me. I am not managing 3 million euros. It's just a good example. Right, so better position coming down from these lows. Half decent position from this area, half decent short, previous weekly highs. And then you've got a pretty good looking short position from that wick imbalance that has basically created all of this to the downside, right? So we've got four areas on the chart, and not to mention up at these highs that are already been identified based on higher time frame buyers. That up at these highs again, it's a nice area for us to be looking for shorts. But overall, big picture, it's looking good based on the daily. Now, 4 hours, where I'm really concerned about structure and how, again, price is being respected by that 4 hour 50 EMA. So for good measure, we can, if we look to the left, or let's just look here, we can say very clear that price is making higher highs, higher lows, higher highs, not a clear higher low, but nevertheless, price took off from that area, and price has now come back down here, a potential lower low or a potential higher low. We don't know at this stage. It's not confirmed. However, in the immediacy, price has then pushed up, pushed back down, so failed to make a lower low. So at this stage, we could still well be in that higher high, higher low for a potential higher high. Alternatively, what we also must understand is price could have made a low in the market. This now is the lower high for a potential lower low. We don't know just yet, as no area has been confirmed. Now, when you don't know whether you're trading alongside higher time frame structure, i.e., in this instance, all what you can do is mark off a good trading range. And that's what we've done. We've got previous weekly high where price is currently trading in between. We've got that wick imbalance and daily 15 May where price is currently trading in between. Again, a good analogy. If price is doing this, let's say price is ranging, that's your good trading range. If price is trending, making higher highs and higher lows, we know that our best positions are going to come from trading those areas. If price pulls back into them, that's where we want to be trading. And in a downtrend, price making lower lows and lower highs, we know we want to be trading those lower high areas for the lower low continuation. So we can say here quite clearly that we don't know, based on this simple drawing, what phase in the market we're in. Therefore, a simple trading range backed by confluence will allow us to take a position. As we already said, these may well not be the best positions on the chart. If I zoom out, there are much better positions for us to be looking for trades for. So again, if you are one of those traders that will say, actually, I cannot diagnose, just like myself currently in this market phase, I have no idea what price is doing on the 4 hour time frame. And the 4 hour time frame is really where I look to concentrate on what structure is doing. So potentially this pair, unless it makes a break of the most recent low to confirm that we are actually making lower lows, and this was a low, lower high for a lower low. So unless I get a 4 hour candle printing below this area, perhaps you could be a trader that would say, well, I will wait until that's done, wait for the pullback, and now I know I'm trading alongside 4 hour structure. That's completely up to you, and that's completely fine. In contrast, you might wait for price to then break above these highs to say, right, I'm pretty satisfied based on price breaking above. That indeed, this phase is now over. That's old history to the left. This is all old history. Now I'm quite happy to say higher high, higher low, potential higher high, higher low when it comes back for a higher high continuation. That might be your preferred method of trading. For me personally, I'm not as picky as that. If I can find a good point of interest, which I believe I have, again, notice I haven't said a great point of interest. It's just a good point of interest at this stage. Couple of EMAs, couple of wick imbalances, some order blocks, refined 4 hour. It is what it is, right? If I can find a good point of interest on this chart, then by all means, I'll be happy to take a short. I'll be happy to take a long. It is what it is, but providing the setup show. It would not be as simple as, right, point of interest, long position, stop loss underneath, let's go for it. There's a lot that will have to go into taking this position, especially for me personally, the short from the previous weekly high. Knowing that this weekly high was certainly not as powerful as this wick imbalance, I'd kind of be, it would be like, well, you've got an opportunity to make money here, but we'll just call it that. Whereas here, you can say, again, yeah, you've got an opportunity to make money, but I'd say it's definitely more proven if you're looking for a short here than a short here. So me personally, I might say, you know what, come Monday morning, even if price looks beautiful from that area, it's a no from me at this stage. It's not happening just yet. I might want to see a little bit more. But then I'm looking at EMAs. How is the EMA being respected? And on what side of the market is the EMA working on? So again, what can we see here? Price has closed above the 4 hour 50 EMA. So I know now that in terms of making a higher or in terms of making a good decision based upon long or short in this area, if we get to charts on Monday morning and price is down here on the 4 hour time frame, again, remember what I said about the magnet. If we have 3.5 hours left of this 4 hour 50 EMA to close, what do I have as a confluence? Again, a rhetorical question. I'll answer it for you. I must have the mindset that the EMA will continue to be respected. Why do I believe so? Well, look at this wick imbalance here. At some point in time, this candle that closed bullish above the EMA was bearish below it. And then, for whatever reason, based on the EMA gods, price flipped bullish. And as you can see, closed beautifully. And I describe it as beautifully because it's almost like magic how these EMAs just work as decent support and resistance for your trades. As simple as that. It closed above it. So again, if I've got 3.5 hours left of this current 4 hour candle, knowing that the most recent 4 hour candles rejected the 4 hour 50 EMA pretty nicely. I mean, look at that candle. Again, Monday morning, slightly different. Some people like to wait for the market to settle. Me personally, if I see the trade and it matches my setup, I'm going to take it. I know that the market doesn't care what day of the week it is, but that's my own opinion. I will take a position. However, let's say I only have 5 minutes left of this 4 hour candle, knowing that I'm expecting price to gravitate towards the upside. I might be a little bit more what would be the best word? A little bit more, well, if I rephrase it completely, I may not want to take that position, knowing that I have only 5 minutes left to try to see if I can have the magnet pull my 4 hour candle back up towards that 4 hour 50 MA. And I'll play a scenario. Let's say then I take a long position from this area and the 4 hour candle then close bearish on me like that. So I've got two options. I can look to close that position with the understanding that okay, price is now closed below the 4 hour 50 EMA. Now the next candle could well open and give me another bearish engulfing start to that candle. However, the analogy still plays on. After the candle then closes bearish below that 4 hour 50 EMA, what am I expecting the next candle to do? Pull up towards that 4 hour 50 minute. And that happened to me last week. I can't remember what trade it was. I'm pretty sure it was a short position. I looked to take the short, forgot completely to check the 4 hour 50 EMA and the 4 hour candle. The 4 hour candle closed against my position and I held it because I had the understanding that, okay, I understand now the 4 hour candle did not do it didn't give me that rejection. It didn't do what I forecasted it to do. That's fine. I'm not a magician. Nevertheless, what I then had the understanding was, well, as a result of that candle closing, I now expect after a low in the market has been created, it's very simple. A low, I'm expecting the lower high. As soon as price makes that lower high, I'm going to move to break even. And that's what I did. Luckily for me, price, and I think that was a trade that I actually took profit on. Because of the distance the 4 hour candle actually closed, in the previous candle, there was an imbalance like so. The previous 4 hour candle, I was able to get break even on the push. And then by the time we filled the imbalance of the actual 4 hour previous candle, I was out the trade, right? So again, it's actively analyzing your charts if you're able to do so, not to use someone else's wordplay. If you are a trader that has to set and forget your trade, well, it is what it is, right? That's the type of trader that you are. I've been there before when I couldn't manage my trades as actively as I wanted to. But take it from me, it's most certainly doable to become a very wealthy trader by not managing your trades actively. In fact, I'll stand by I was considerably a better trader by not being able to manage my trades the way I can now. And as I said, it's a session not just for chart analysis, but imagine the differences that you have if you're not able to actually view your trades and manage them actively. It's about risk management, knowing that I can watch my trades all day and be enticed to close my positions early, micromanage my trade. You know, as I said, I'm not a magician. I'm like you guys listening. I'm just a trader, right? That happens to be profitable, that happens to have some financial backing from individuals where I'm now forced to make better decisions, right? If I don't, I lose okay, I don't lose everything, but you get the picture. So I can understand both scenarios if you're trading that you can't manage your trade, but again, your risk is always going to be managed. And investors love the fact that this guy, he takes trades, he closes them consistently at 1 to 3. His trading panel does all the work for him. He's not subject to FOMO. He just marks his best positions every day like a good boy. When price gets into those areas, he refines those areas. He'll set a sell limit and he'll take off in his aeroplane and won't manage the trade. And he's not concerned about what happens. That's the perfect type of robot that you would want to be, right? That's how most of us aspire to be whilst actively managing our accounts and trades live, right? But for some reason, we get pulled into micromanaging, moving stop losses, extending take profits, thinking that price is going to go to the moon. And then next thing you know, you're left with nothing. You've taken a stop loss for no apparent reason, right? So again, it doesn't matter what type of trader you are, as long as you can identify those key areas in the market and identify that perhaps for me, for example, the old version of me, I wouldn't be looking at this at all because I'd say, well, actually, there are much better positions to be risking money on from the lows and from the highs. Now, because I'm actively able to monitor my charts more aggressively, I can say, right, well, as long as I'm on the right side of the EMA, I'm more inclined to take a long than I am to take a short. So I already know that moving forward. However, 2 years or 3 years ago, when I'm just using limit orders, none of these would be into my thought process. Zero. I wouldn't consider any of them. And that doesn't make it wrong and that doesn't make it right. It's just what type of trader are you? So as soon as you can identify what type of trader you want to be, honestly, take it from me, trading becomes so much easier to say, right, I know price is there, but I'm not interested until something happens. This pair's crap. Move on. How easy is that? And again, if you're an investor, if my investors are watching me or listening to me, that's what they want to hear, that I'm not risking money in areas that I don't really have much faith on, right? However, having the flexibility, as I said, and having the go ahead from certain investors to I can take certain positions, then of course I'll look to take a long aside from taking the short. I already know that, right? So that's the level of detail that you need to go into, every trading day. If I say every trading day is the benchmark, if you can't do that every trading day, then perhaps the trading day that you don't feel up to it, that's not a trading day for you, right? It's this level of detail that's required. So the 4 hour, again, price, how is it being respected? Respected on the EMAs to the upside. Therefore, again, to support what I've just said, as long as price retains underneath, or rather retains to print above that EMA, I will be more inclined for longs from the lows, and I'm not involved in shorts. The reason why, if I'm to take a short from this position, where am I trading to? Where's the rejection coming from? In the immediacy, it's the EMA because rejection, rejection, price holding above. So as soon as I enter that trade, I know it's going to have to be an aggressive type of trade with an aggressive type of entry management start. Whereas trading from these lows, I don't have to be as aggressive, meaning that before I even take that position, I know that I'm going to wait for a certain entry criteria based on the fact that I don't need to be the first person in this position because I'm racing for price to get to the 4 hour 50 EMA before the rejection. I know that if price retains above that EMA, anything below, price is going to want to push back above. Therefore, I've got good enough range, and you'll see me measure the range more often than not. Right. So just by from 4 hour order block to the EMA, and that will be price just doing the least for me from to get towards that EMA, I've got 70 pip. So I know I can hang around, wait for some 15-minute breaks or structures. When price gets back down to that area, potentially I'll wait for a 15-minute bullish engulfing candle, mark the imbalance, lower time frame, 1 minute break of structure, and I'll take the trade. And for me, that's a hell of a lot to wait for, considering I'm pretty darn certain. Okay, I'm not certain on that area. It's a good point of interest, but it's a trade area nevertheless, right? And I'm still going to look for a certain degree of criteria before taking that trade. Of course, if there's an Asia range in between, in the middle as well, with an Asia range available up at the highs, I'll tie that in with some confidence and say I took that trade because even Asia range was available to those highs. So it's tying everything in, recognizing where the EMA is, recognizing where your higher or your best point of trade is going to come from, and then say, right, where am I risking money from today? Where would I prefer to lose money from is a better question. Where can I explain, forget investors, forget all of that. As an individual trader, where am I happier to journal that I took a trade from, knowing that I've done all of this analysis? I then go and take an absolute shitty sell from a previous weekly high against the EMA. I don't manage my position enough, and then I understand that after this high, this could have well been a higher low for a potential higher high coming in up here. I've taken a short, the EMA's come right back up, it's rejected, and then there's a higher high. How am I going to feel if I take a short from there after just forecasting pretty much what I believe price is going to do, right? However, on the flip side, if I say, well, I could identify that a price had made a high in the market. Right, I understand it didn't make the previous high, but break the previous high. But asking price to break the previous high before I take a long position is a bit of a long shot, right? That would be a bit unfair to me as a trader to say, well, actually, Charles, unless price breaks the previous weekly wick imbalance high, I'm not going to take a trade. No, that's not going to happen. That's not fair to me. It's not fair on my investors. It wouldn't be fair for you to listen to me talk absolute rubbish either. So after a high, I'm expecting a higher low for a higher high continuation. So if I forecast that and say, okay, what's your contributing factors for that trade? wick imbalance from a weekly time frame, refine daily order block, daily 50 MA as well to come and push price up, refine the 4 hour order block that's sat there still unmitigated, refined on the 15, and then as we go to the 15, we'll have a look what an ideal 15-minute time frame could well look like. But journaling, again, another rhetorical question. Journaling the position, forget what happens, what would feel more comfortable to lose? And for me, I'd be happier to lose a nice textbook long position than lose that short position, right? So again, where can I manage? Where am I best at managing my money? It's from the lows. It's from that long, in my opinion. I hope that makes sense for everyone listening on live and on the recording. So, 15-minute time frame. I'll have a look what it looks like. Of course, it's pretty old data. Again, the analogy that we drew before, we couldn't decipher really clearly on the 4 hour time frame what all of this was, right? We'll go back to it and we drew that out. I can't make out whether this is a high or whether here is a low for a potential lower low. Nothing's confirmed just yet. However, we've used the EMA and we're pretty certain that I'm pretty certain just now that I'd be more inclined to take the long than the short. So let's see what's going to support my long in looking for a trade. So based upon zooming out, sometimes you can do this. I wouldn't expect you to start zooming out to the previous year like so, but just to gauge where you are on that higher time frame, zoom out. Have a look at any key points of interest on the 15. And again, you don't need to be precise just by looking out like that. But what you can say is, right, there's an area here that price made a low and price just took off, right? And then, of course, from this area, you wouldn't really be able to eyeball it because I've done that by refining the 4 hour down into the 15. But most certainly, the lows in the market. It goes back to what I said initially. Where would I want to be taking a long position from? The absolute lows. That's going to give me the best type of place to put my stop loss. Because if I know I'm going to take a long position from as low as I possibly can from my area, let's not think about this area below. From the area that I'm looking in, this daily order block around the daily 50 MA, the wick imbalance. I need to be looking in that area as low as I possibly can. That doesn't discredit this area here, but what it does mean is that I know that this could well be the more risky of trade. However, this is supported by the same elements, albeit they're a lot closer, but it's the low in the market, meaning that if I take a long position from here, it's very clear where I want to be putting my stop loss, is it not? Even if I zoom out to the left, it's a low in the market, so I want to be putting my stop loss below the lows. However, if I compare the stop loss placement to this position here from that 50-minute order block, I now have the conflict. Right, in an ideal scenario, I know I want to be putting my stop loss here. In an ideal scenario, does that make sense? No. Are my investors going to shoot me for doing something like that? Potentially. However, I know that I need to be putting my stop loss around about here and accepting the risk for that particular position. Therefore, if I'm going to be aggressive in one position, which area is that going to be in? The absolute lows, where I believe price could well be looking to gravitate towards, or I'm going to be aggressive from this area, potentially lose money pretty quickly. Oh, sorry, everyone. Find my potentially lose money very quickly. Price come down to the area where I really should be looking to get a nice aggressive entry, then decide to be patient here because I've just taken a loss here and then miss the trade, right? So that is the forecast that you need to go with. Where's my better areas? Where am I most happy to journal a losing trade? What position makes sense? So come Monday, let's say price is down here. I say I'm going to be aggressive, but being aggressive for me nowadays, it doesn't mean set a limit order. But most certainly, the older version of myself would look at setting a limit order perhaps from the midpoint of that order block, and I'll look to just get a clean 1 to 3 out the market. Forget about the fact that I'm expecting price to want to gravitate towards the 4 hour 50 EMA for a 1 to 10 or 1 to 12. I'll be looking for a 1 to 3 out the market. Everyone's a winner, right? And the fact that I'd have to be taking a limit order would mean that my stop loss would have to be in a position where I wouldn't really want it to be, right? It would have to be almost a quarter of the size bigger. just to counteract the fact that I'm not really going to now be waiting for price to come below those nice areas, then give me the break of structure for me to get the actual entry that would present itself around about there on the pullback. So I've got to take everything into consideration. So as I'm now more of an active trader in the market, there's no need, even I should probably change the terminology of an aggressive entry because there really isn't one. I know that most entries are going to take me, once I've found a point of interest, at least 15 minutes because that's a 15-minute candle closure. So unless we are at ultimate highs and I look across the charts and I see there's absolutely nothing there in that area, then perhaps I might look for an aggressive 1 minute break of structure. But even with that said, a 1 minute break of structure is more than likely, once it clearly breaks for me, if you play the game for me, this is price coming down on the 1 minute time frame. A 1 minute break of structure is not that for me. I need to identify a solid place in the market. For example, where made the previous low? So that would be the previous low. Then we see price come off from that area. That is now my structure point. So I delete that and I move across. Now, if price now comes into an area, gives me, let's say, a double bottom and pushes up and comes back down, that is not a break of structure. By the time you get the clean break of structure from an area, more than likely what has happened anyway is there has been a bullish 15-minute candle closure from an area because what will happen is price will then begin its change of character, but it hasn't changed the trend. We are still very much so bearish. So until price actually breaks above the area that created the most recent low in the market, I'm not going to be satisfied that I have had a break of structure. Again, I have to journal these trades. I have to show people these types of positions that I'm taking. Therefore, it's very easy to do, right? I understand if you're chasing challenges, you're trading personal accounts, you want to be aggressive, but if you just look to hold yourself accountable and be responsible for your entry criteria, as I said again, trading becomes so much easier the moment you just follow the damn plan, right? Break of structure it comes back down. As it goes back off, more than likely you have that bullish 15-minute candle. Once you've got the bullish 15-minute candle, you will have those imbalance left behind on the lower time frames, still there that price hasn't come back down to. Then with that said, you've got the option. Do I take it from a 1 minute order block from those lows? If there isn't a 15-minute order block because the candle printed isn't an engulfing candle, it's just a bullish candle at that stage. If it's engulfing, then of course you will have a 15-minute order block. However, you'll be slightly higher. Below those order blocks will be the 1 minute order blocks sat there waiting for you. You have my word, they will be there if you have a bullish engulfing candle. You will have an order block on the lower time frames, right there at the lows. Then it's up to you. Do I wait for price to come down to the lows, allowing me to what? Again, another rhetorical question. Long from as low as possible. Understand once you long from the lows, it's very clear where you put your stop loss. If I then take a long from the 15-minute order block, that would be considerably higher. Look at the question I have myself. Do I trust this order block or do I understand that price may want to gravitate towards the lows? Look at the range. Again, what type of trader are you? Are you going to wait for price to do that? Stick your stop loss there? Are you going to be a trader that puts your stop loss there? Are you going to be a trader that waits for price to come back down to the 1 minute order block? It's personal. It's whatever you can journal. And I know not everyone is in the position that I am, where my journal, not that your journal doesn't mean any, that's completely wrong. Your journal will definitely mean something, regardless of being funded, regardless of having private investors, regardless of trading on behalf of a PAM, anything. Your journal is very, very, very important. And I bash on and on and on about a journal because you're able to pull up positions that you've already done and you have that data to say, you know what I'm going to do today, I'm going to trust this order block because last week I took a position and I trusted my order block. And you know what happened? Price just came back down to that order block. It wicked it and off it went. And if you don't have that, you might say, well, actually, I know that price sometimes wants to come back to the 5 minute order block left behind. So if I have my limits set by the 5 minute order block and I just cover those lows, yeah, I'm pretty comfortable with that. I've got a much better entry than the 15. I've got a good range up to the high of the candle that actually created it. I can go break even aggressively. So all of these scenarios, I can only talk about them because I've used them all. I know exactly what's coming after a bullish candle. I know what's coming after a bullish engulfing and vice versa. If it's a bearish candle, I know exactly what's happening after every candle. So as soon as I see a 15-minute candle, whether it's bearish or bullish, from a point of interest that for me, more often than not, will have to be better than a good point of interest for me to be that aggressive, I'm straight down to the lower time frame. I'm onto the 5, I'm onto the 1. What's going on? I'm marking off imbalances on the 15 candle, marking off imbalances on the 5, and taking positions. Why can I do that? Because I've got a journal of over 1,600 trades. As boring as it sounds, I've got that data and I've been collecting that data long before private equity, long before funded account, long before I even knew what I was doing, to be quite honest. But I have the data. It's there in front of me. So I can always look back on it and say, you know what, Charles, you've taken some of those trades. They're shit. Don't take them today. Take them when you're 10% up for the month and you want to take an average looking trade just for the sake of having a bit of a gamble, which again, wrong mindset. But when you are able to take positions that you know can pay off, regardless of being shit, is then for you to choose when you want to take those shit trades. And it's then for you to choose, well, how much are you going to risk on that trade? Are you going to risk 2.5% on that trade? Are you going to risk 0.25% on that trade? Are you going to risk 0.1% on that trade, right? These are the questions you've got to ask yourself. I can only speak with such confidence because I've done it, right? And you guys will get there. If you feel like you're not quite there, again, journal, journal, journal. I bash on and on and on about it. I bash on about teaching my missus how to trade. How can I hold her accountable when I think all she's doing is watching Molly May on YouTube and not trading? Then she'll show me her journal and say, well, actually, you thought I wasn't doing this and that, but look at this trade, look at this trade, look at this trade. What can I say? You know, she's someone that I invest in her to trade because she's proven through the course of her journal that she can follow certain steps and make certain returns. So your journal is very important to you. And I'll be honest, if you can have a good year of trades on your journal and people will be finding you to manage their money, it's a very, very, very simple thing to do, especially when that journal is verified. Um, it's just a whole different ball game. You'll stop focusing on funded money. Again, I don't want to sound like an arsehole that, I'm not really concerned about funded accounts, but there is so much more out there that we're unaware of in terms of being able to trade types of capital, right? And this is why I'm happy to introduce it to anyone listening. Funded accounts is only the beginning for you. Trading personal money is great, but how about trading someone else's money? It's even better. You're paid to do it. You get a commission of the slice. It's an ideal scenario, and there is no expectations on your type of return. There's no max limit on the drawdown. It's just fantastic, pretty much. So where are we going with that? 15-minute. Excuse me for a second. 15-minute time. Grant. So again, two nice points of interest within my area. Again, this will not be aggressive. This one potentially could be. And what I mean by the difference from this area, let's then say price is trending down on the 15. Use your imagination with me. That's 15-minute structure. I might say, well, a low in the market was created, and you have to understand, once price starts coming down like this, we are now bearish. Forget everything to the left. What's happening now? We are currently bearish. How can I have some confirmation on taking a position where I can see we are quite clearly bearish? What am I going to do? I'm going to mark off an area that made a previous low in the market, a potential type of entry criteria. What am I going to do? Wait for price to break above, not break above these highs. Just show me something from that area. It's an old area. Show me that you're willing to provide at least a little bit of liquidity for me. Pull back. Once that break has happened, I can pretty much guarantee you there will be an order block of some sort from that area. If that break was a result of a bullish engulfing candle, engulfing is the difference, you will have a 15-minute order block to start your foundation from. Simple. It will always be there. Take it from me. An engulfing candle on the 15-minute time frame will give you an imbalance. It will be there. Then it's up to you how you're going to take it. You now understand that, okay, the trend was down. I've had a break of one structure. Is that good enough for you? You might then say, well, actually, I'll wait for a 1 minute break from that area and now I'm happy to go. Or you might say, you know what? I'm going to take a limit order. As soon as I've got that engulfing candle, take a limit order from that 15, and that's what I'm going to do. And I'll bring it up to my most restricting EMA, which at this case will be the 4 hour where you'd be expecting a rejection for up, right? So that's a rant and a bit of an analysis. From the highs, I'm really not interested at this time. It's not even worth going into it. So I'll quickly run over one pair and again, and then I'll let you guys enjoy your Sunday. What was the best pair that I had a good look at? Let's just go through the higher time frames. Oh, GU, was it GU? No. G card. Was it EG? Ah, forget it. Let's just pick UCAD. Right, UCAD, weekly time frame. Let's make it big. There we go. Cool. So again, structure. Am I interested? No. Overall bias. Am I interested? Not really. What am I interested in? Weekly EMAs, weekly candles, wick imbalances, order blocks of some sort. So price has been held above this area since 2024, September to be precise. Then had that wick created over here. So I've given that just a wick imbalance, no more than that. It's just the wick at this point. We're not going to be taking trades directly from wicks. We need to see confirmation come from those wicks before you take it. But nevertheless, it's there. Where's my higher probable setup coming from? Right. So regardless of me thinking, well, what I know what's going to happen with price action, if I delete all of this and I'm simply left with an order block and a weekly 50 MA based upon the last type of price action and respecting that EMA, price is broken below it, so I'm expecting price to come up to it and reject it. So I know that my higher probable setup is going to come from a short from those highs once refined. And again, look how the EMA is placed in contrast with the order blocks. So what I've said previously, how I much prefer to have my order blocks and EMAs. Look at the EMA, it's below order blocks. So price comes into that EMA, especially on the weekly, it's even better because don't forget, you've got 7 days for price to want to reject that EMA. So you don't want to be taking a position straight away from a weekly EMA, knowing that it's got potentially five, sorry, not 7 days, 5 trading days to reject that EMA. So come Monday morning, if price comes into that EMA, I'm not going to be looking for immediate shorts. I know that price wants to go deeper into that EMA, find a valid point of interest, what we've already done, prepared. Daily is refined, 4 hour. Where is it compared to the daily? We're up at the highs. Can I imagine that there will be a 15-minute order block even higher? Perhaps. So by the time price comes up to that area, right. Now, how long of that weekly candle do I have to reject that EMA? 1.5 days. Perfect. We spent Monday, Tuesday, Wednesday pushing up. Let's have a rejection on Thursday, on Friday. Let's close below the EMA, right? It's that kind of level of forecast that you need to have going ahead if you understand the time of trading. So, best position up at the highs, also best position down at the lows for a potential sell. Why is that? Well, based upon this order block, we've not broken it since September. We've tried to come into it again, June 2025, failed to break. Now we've had a really good attempt, but look at the wicks coming from that area. For whatever reason, again, as I've said, I don't trade fundamentals. I'm really not interested in fundamentals. Once you're past um, challenges and things like that, you recognize that it's just noise in the market, and actually you look forward to fundamentals because that's actually something other than just price action. When price isn't moving as you want it to, that's the shape that it gets. I look forward to CPI. I look forward to NFP because when the build up towards those areas, those times are more than likely very dull and boring. You're not getting much liquidity in the market, no volume because everyone's waiting. So when those areas start to come in, or when those news releases, economic releases start to come in, that's actually when I get more excited as someone that doesn't have the restriction of trading funded accounts that pretty much don't let you trade around those areas or all kinds of different rules. So I haven't really been paying close attention to fundamentals for a very long time. It's only since really having the community that I understand, okay, people need to be aware of fundamentals. I don't want anyone to start blowing their accounts, taking positions. If I'm taking them, I don't have that same restriction. Nevertheless, I know that from these lows, wick imbalances, again, where is the wick imbalance compared to the order block below? So I'm not going to be inclined to take immediate long positions as soon as we come into these lows. I'm expecting price to want to be magnetized potentially towards that wick imbalance. If I don't have any clear confirmation in these areas, if we just start ranging in these areas, I'm not going to be taking a trade from the lows. I'm going to expect price to pull down, shake everyone out, give a lower time frame break of structure, and then that's where I'm going to be looking to the trade. Again, planning well ahead of it even happening. So when it happens, it's just so easy for you to just it's not even a reaction. It's more of a it's already planned. Let me just set the trade and move on with my day, right? Again, as we mentioned before, areas within, are they going to be my high? Are they going to be my favorable trading areas? Potentially not. Maybe they are based on EMAs, as we can see. Price currently below the daily EMA. Now we'll have a look at price action on the daily and the four to actually say, well, is it worth taking a short from this area if we're aligned with 4 hour structure? Would it make sense? Like the previous pair, I'm happier to take the long and I pretty much X'd out the shorts, right? And it looks like potentially I'm going to be doing the same thing here. Just based upon those weekly candles, I can see that potentially we've made some lower lows here on the 4 hours, particularly on the 15. We've never come back to retest that low. So here is the low on the 15. Price had then started to pull its way back up. So in and around these areas, I'm expecting a decent point of interest. What's that backed by? Then I have to ask myself, is it actually just an order block out of the middle of nowhere? Or is it a proven point in the market where I want to be risking money from? Daily 50 MA, good place to start. Wick imbalance, we're on the daily time frame now. Right. Is there any order blocks in that area? No, there's not, unfortunately, on the daily time frame. So potentially that is against me already. Sorry, my dog is dreaming, hopefully dreaming of money and a better life. Nevertheless, a daily 50 MA wick imbalance, 4 hour order block. Again, time frames and structure. On the daily time frame, what's going on? More often than not, I'm not concerned unless it's clear and obvious. We have made a very clear low in the market. After a low is made in any market, expect a lower high, lower low continuation. So potentially, here was the lower high. Would that make sense? Well, yeah. Where did it pull up into? Price at one point pulled back up into a daily order block that was there. Price refused to break above it. Price respected it and started to create a lower low. However, it's not confirmed just yet, as this is the clear low in the market. Until this low is now broken, I cannot tell you whether this is the lower high until we have a confirmed lower low. So, with that said, anywhere in between is pretty much no man's land, like the previous pair. I can't tell using the daily time frame just yet. Hence why I don't really take it into consideration. All I know is price, daily 50 MA, price, wick imbalances to the low. Happy to trade either direction at this stage. So let's take a look. And also the EMA placement, is price respecting it? Well, we were trading below it, projecting it. We broke above. So at that stage, I was really expecting price potentially to come into these areas before after a break, then a push up to make a higher high. It wasn't to happen. Price made that lower low. So again, lower low, lower high. Let's see where we are on the 4 hour time frame. Now I care about structure. Now I care about EMAs. Now I care about everything on the 4 hour time frame pretty much. So again, do I have a valid order block in and around this area that was a point of interest for me based on a wick imbalance and a daily 50 MA? Right, there's that 4 hour order block. What has that 4 hour order block done? It hasn't created a lower low in the market, but most certainly it has created a shift in price. Because as we were saying, after price was making clear lower low, lower high, lower low, price then took off. It didn't break the most recent lower high, granted, but at the same stage, it hasn't made a lower low. So the same consideration must go into this. Is this now a potential high in the market for a potential higher low, followed by maybe a higher high? I can't tell just yet. I'm not a magician. But what I can do is use the range that I have between to come up with a higher probable trading position. If I can't, guess what I'm going to do? I'm not taking either position because I got to risk money on these areas. And if it's not worth it, it gets a big red X. EMA, 4 hour EMA, where are we? Price has closed above it. So I know now that with price closing above the EMA, price is going to want to reject that EMA. So if I can't tell the strat, and this is a good example of a trade possibly that I won't trade in any direction because I'm just not clear. I don't feel as clear as I was with the previous one to be as a result of not having structure really on side. So we got the low, lower high potentially, lower low not created, and we have the EMA just sat there in the middle at this stage with price just about closing above. So again, when it's just price is just about closing above, is that nice to journal for an investor to read that I took a position because price just about closed above? And again, forget about investors, but focus on the journal. It's your personal journal. When you write this in your journal, okay, price just about closed above, so I risked £1,000 on it, for example. It's just not good enough, is it? You want to say definitively that right, price close above that 4 hour 50 EMA, the bullish engulfing candle. That then suggests to me for the area that I'm looking to take a position from is willing to push off from it. So as a result of that bullish engulfing candle, I then knew that I had 4 hours left of the next candle to come and push down. And then I know that price is going to want to gravitate and magnetize back towards that 4 hour 50 EMA, if not close above it, because that's a theory that I work with, right? Look at the difference. Look at the difference in confidence on how you can journal it, the difference on even how the chart would look, right? So at this stage, really, how can I look at that? I want to see, coming from that area, a reason why I should be involved in anything. Because at the moment, that's not meaning anything to me. At the moment, this doesn't mean anything to me. And why? Well, look what price can do. Price can actually trend nicely. So although that could be a lower high for the lower low, as I've said multiple times, at the moment I'm in no man's land. So the better position, what would I go with? I would probably go with overwhelmingly taking this into consideration, we have made a low in the market. And what I would say is, well, this would be the key structure point. So this is real in-depth analysis based upon pretty much looking for a trade, not actually having the trade come towards you. It's not clear, but at some stage you're going to know how to make money from average points of interest. So here's a key point in the market where unless price breaks above, I'm not really concerned about taking long positions until that happens, right? And then, so I know that price is still potentially looking to make that lower low based upon previous price action. So what do I want to see? I want to see that. So what has happened with that EMA? So price closed above it. So that's a conflict straight away. So if I say that price was looking to trend above or started to trend like so on the 15-minute, I'm going to need to look for a little bit more than just a trade from this area. I want to see the wick imbalance being filled. I want to potentially see a tap into that daily 50 MA and a nice rejection from that 4 hour order block like so. And that will then leave me with a wick to the high. Then once that's happened, I know I'm trending against the 4 hour or the 4 hour EMA. Once we have that more, there will definitely be a 15-minute order block there. And then that's how I'm going to forecast to take that short position. The reason why, because I know that there are much better pairs out there for me to be wanting to risk money on. If I say I want to wait for all of that, come Monday morning, if that happens, or Tuesday, if that happens, there's my trade. I've waited, I've planned it, it's come to me. So although I like the fact we're trending down and I'll be happier taking the short position, I'm not convinced because the phase is pretty much over. I would have expected price to hang around in this area, show me still that we are in that downtrend, and then I'll take the short, right? Same goes for the long. To be honest, I'm not convinced that we are now over with the downtrend and we are making now higher highs and higher lows. I can only get that information judging on that. So if I'm going to disregard all of this to the left and only take into consideration this, I'll be a bit of a fool, right? So currently, I already know that there aren't really any great setups coming from whatever pair this is, right? Now down to the 15-minute time frame, let's see what's going on. So here's that clear low in the market that was created. Well, we're not really sure whether all of this is actually on the higher time frame after this low. Here is now the lower high that we're searching for that lower low. So what I can say is, well, it's as simple as this, Charles. You've just got a trading range. Is it your best trading range on the chart? No, it's not. Can you look for a position in there? Potentially. What are you going to have to see? I want to see some nice breaks of structures coming from the highs and also from the lows. I want to see prices down here at some point. I want to see much of the same. I want to safeguard myself that price doesn't make a lower low. Because if it makes a lower low, all of my analysis would then be incorrect, null and void, right? So a lower low I don't want to happen. The only way I can safeguard myself to the best of my abilities is wait for a shift. So after price starts coming down like so, wait for the shift, the break, the pullback. Support me with something. Show me that you're going to do something from that area. Then even so, if I'm not satisfied by that, then I can wait for price to dip back down, fill an imbalance left behind, which would be something like that. And then off we go again. And again, I don't need to be the first person in that trade based upon that trading range. EMAs, of course, will then be taken into consideration for targets, but just by eyeballing that, got quite a considerable range to the 4-hour 50 MA in both scenarios. So whether I take a short or whether I take a long, I've got enough range to wait for something to happen before I look for any immediate positions. Of course, it will be different if I leave us all with this last scenario. Let's say then we'll play out a nice Asia range. Come tomorrow morning, we have Asia like so. So, criteria of eight, let's make it bigger like that. And then let's say price comes down and then makes Asia to the lows, makes Asia to the highs, and something like that. Let's make that all Asia. All right. So that's Asia range. Get to the charts tomorrow morning. What can I do? So I've already said I'm not really concerned about, or I am very concerned rather, about taking the position without confirmation. So I've got now a choice. The Asia range is there. Can I trade it? Yeah, at the moment I can. Why can I trade it? Well, I can say from this 15-minute order block, I've had considerable breaks of structure to the left. Don't overcomplicate it. Have you broken structure to the left from a 15-minute order block? Yes. Therefore, you're going to validate self-validation of that order block based on your analysis. Price was making lower lows and lower highs, came down to whatever place in the market, pushed off, broke structure one, broke structure two. Is there a minimum amount of structure breaks on an Asia range? No. It's personal. It's whether you feel that price has broken structure to the left, right? In my case, yes, it has. I'm very clear on a break of structure there. So then, Asia happens, starts printing down. Price is hovering around an area. Then we've got this to consider. Asia internal structure. We then also have Asia range to fill to be considered. Is this a valid 15-minute point of interest? I have validated it. The difference is now we're using an older order block. So what I will be looking to do personally is regardless of what happens if London opens, that's the opposite direction. Let's say London opens, we want to do it like a different way. Let's say London now opens, breaks structure to the upside, comes back down. Regardless of this being a break of structure within internal Asia, I'm going to want to see a 1 minute break of structure. As soon as I get a 1 minute break of structure, I'm taking it. Why? Because it's an Asia range trade. So it's a different type of journal satisfaction for my investors to look at. And also, again, forget the investor, for you to look at what type of trade have you taken? Right, I've taken an Asia range position. The time frames, what is it based on? It's not based on the higher time frames, 15 and 1 only. Can I satisfy the criteria for an Asia range setup? If the answer is yes, take the position if you feel that you want to do so and trade it. And that will be the only opportunity that I will have to take this position before I get what I've just forecasted before, that I want to see something significant coming from these areas before I take the long, based upon the fact that we're just kind of nearly areas. We're nothing special at the moment. Judging on how price trends, what are we doing now? We're nothing. So these points of interest, they're just good, okay to good. They're not great. They're not at key areas. They're not at the absolute lows. They're not at the absolute highs. And that's pretty much it, to be honest. So, yeah, I hope you guys can gain a little bit out of that. Of course, it's just the weekend breakdown. As I said, it's not financial advice, but it's just the way I have managed to manipulate the markets that have been seemingly okay for me. And then just the takeaway would be, of course, if you don't have the time to do all of this, then I understand that I too wasn't always in the position to sit down pretty much every day and go through my charts, right? I get it. I'm only human and normal like you guys also. But I guarantee you there is a point in your day where you're not making useful time useful. Whether that's doom scrolling Instagram, what Trump is up to next, what's going on in the world, watching news. That I guarantee there is a point in your day that you are kind of idle. And if you are able to at least mark one pair, I didn't used to trade this many pairs. I used to trade 1 to 3 pairs. Some of the original people within the groups would remember. I only had 4 pairs on my chart because that's what I was just happy managing. I know I could easily analyze 4 pairs to the highest of degree. I could set easy limit orders on at least one of them easily. So even if you're able to forecast one chart, use GU. It's the most traded pair in the world. It's going to be open if you're a UK trader, and you're going to have ample opportunity on GU. Wait for a clean setup on GU from the highs and the lows. Trade GU only, right? I used to do exactly the same. So, as I said, there will be a time in your day where I'm sure you can mark at least one chart to this level of degree, this level of, right, I'm forecasting if price breaks up, what I'm going to do. If price doesn't break up, what am I going to do? If price comes to an area before actually doing anything, what am I going to do? Am I going to jump in a trade? Have all the scenarios in your head already made up. And then by the time you get used to doing that, your scenarios will be the same across all pairs, meaning that just set an alert for this, for example. I know that this is a nice area in the market, but I already know come tomorrow morning, I'm not taking a long from here. I'm just not doing it because just looking at it, I don't want to get involved in this when I don't need to, right? This is just one of those gamble trades that you're going to be a standard retail trader and you're going to trade support and resistance and just hope that you continue to bounce off an area, right? We are better than that. Not to shit on retail traders, but retail traders complain far more than we do as smart money because we wait for breaks of structure if we can. And if we set limits, that the limit is set based on a previous break of structure. Hence why we're now using the facts to set a limit, right? We're not just going to say, hey, look, area, sell or buy. It's not what we do, right? So again, I hope there's enough takeaways from this. Be motivated if you're currently not motivated. Understand that I too was not in this position and understand that there are certain ways to trade the market, it's individual to yourself. And I'll be back tomorrow morning, I think, pretty much all week. I'm at home, unfortunately, being pestered by the missus, but hopefully the markets will allow me to stay sane. So thank you guys for your attention on a Sunday. Ian, you're here. Victor, I see you're here as well. Do take care, fellas. I hope you got something out of that. And to everyone else listening, thank you for your time. All the very best. It's time for an ice cream, I think. Take care.